Good morning, everyone, and hello from the Pathfinder team. We've been excited to start seeing clients in person again in the office, and we're also looking forward to our events starting again next month. One of those is our mid-year outlook. We wanted to give a little bit of update to the market now in anticipation of that event. Brad McMillan, the Chief Investment Officer for Commonwealth Financial, has released their risk factor update, and I'm going to go through some of those slides just to give you a little backdrop on what's been happening lately. Brad and his team put together this risk factor update based on 4 indicators, which I'll go through now. Let's start first with talking about the economic recovery, which was and continues to pick up steam in May in particular, driven by their continual improvements in the public health front on the COVID side, and then also ongoing reopening efforts across the country for businesses. Improving business confidence was certainly a highlight as the service sector confidence reached a record high. May employment data came in and showed the pace of hiring had accelerated following a lull in April that people were worried about. And then, thinking about these economic risk levels overall, we're still seeing Brad and his team put them at a yellow rather than, sort of a green light, yellow light, red light. So it's still a yellow for now. But upgrades certainly look possible to green as we look at the continuing pace of hiring. There's definitely progress that's been made with the pandemic, but there's still real work to be done to get the economic activity fully back to pre-pandemic levels. The uncertain path forward, which hopefully is back to normal, indicates the economic risks are still a little bit elevated. So the first slide here shows the service sector. And this indicator did increase from 62.7 in April to 64 in May. And really, folks thought it was going to be a more modest increase. This result brought the index to its highest level since these records started being tracked back in 97. So that's a strong pace, and that's great to see. Service sector confidence has rebounded well since it suffered from a largely weather-driven decline in February. The index has now remained above pre-pandemic levels for 3 straight months. We would anticipate that again for June. Service sector confidence has been supported by public health improvements in the COVID side, and then also associated easing of state and local restrictions, which have given business owners more confidence to do things with their business and see more customers coming through the door. The high levels of service sector confidence are certainly a good sign for business investment then and hiring, as those also help improve the confidence and then hopefully will support faster spending growth. So given the better than expected result we had last month and the fact that the service sector confidence is at record highs and well above pre-pandemic levels, Brad and his team have left this indicator as a green light, as you can see in the top right. The next indicator is the jobs market. So the May's employment report did show that the economy added about 560,000 jobs. This result was a noted improvement because there were only 278,000 in April, and people were really worried. It was still below the estimate of 675,000, but it was still a great number, and it did show that there's 5 straight months with job growth. It hasn't been really a temporary lull since December in holiday season. The largest hit sectors of leisure and hospitality saw some of the largest gains in May, though. And I think that had a lot to do with the continuing easing of the restrictions that allowed, again, more businesses to reopen and hire employees to meet the consumer demand. There's still a lot of work to be done in this area. Unemployment rate declined from 6.1 to 5.8. While May saw year-over-year job growth increase by 8.9%, it was primarily due to the large decline from last spring when lockdowns were implemented. So the number of jobs across the economy still remains down by more than 7.6 million pre-pandemic levels. And then, the continuing job growth during the month was a positive development. It really could take more than a year of hiring at the same pace to get us back to those pre-pandemic levels. So given the decline in the overall employment compared with the pre-pandemic peak, they've kept this indicator at yellow for now. Upgrades are certainly possible to green, but that's going to be right in line with accelerated job growth. Next indicator is the yield curve. Yield curve narrowed slightly for the second month in a row. The flattening in May was driven by a decline in long-term interest rates. The The 10-year Treasury fell from 1.65 at the end of April to 1.58 at the end of May. And the three-month Treasury yield remained unchanged at 0.01%, which basically means that there's no yield. While these short-term rates are expected to remain low through 2022, maybe 2023, the long-term rates now sit near pre-pandemic levels, which is reflective of a normalized growth expectations. The Fed did make announcements this week, and that was largely unexpected that they would mention raising rates in 2023, but I would just highlight that we're still at very low rates, and that has historically been good to keep the economy moving in the right direction. And talking about what the Fed may do in 2 years from now is probably nothing that we should be trading investments based upon. So right now, yield curve is still very much a green light. And then the last one is consumer confidence. And that dropped modestly in May, with the index falling from a downwardly revised 117.5 to a 117.2. But that was against calls for an increase. So although relatively unchanged, it's still the second highest level for the index since the start of the pandemic. So, I think May was largely driven by rising concerns about inflation. So we may see that again in June, but the index remains at healthy levels, which certainly should continue to support consumer spending growth. And again, this is largely due to improvements in public health, people getting out, businesses open, but it also still has to do with additional rounds of the federal stimulus payments that are continuing to work their way through, and continued job growth. 36.4% year-over-year increase in confidence, but you're looking at May over May, but it's a highlight number. Historically, declines in confidence of 20% or more over the past year are a signal of a recession. So the recent improvement year over year in the past 2 months has been very encouraging, even if it's largely due to comparisons of last spring. Given the fact that confidence has now returned to near pre-pandemic levels and it remains strong on a year-over-year basis, the indicator has remained at green light for now. So continued job growth and progress on vaccination front should help support continued improvements in consumer confidence, and that means more spending growth, particularly as we're entering summer. In conclusion here, the economic data released from May largely points to continued growth in the months ahead. There are certainly signs that the recovery still faces headwinds. And then, the progress of getting people back to work still has a long way to go, but it's in a good position and moving in the right direction. Pace of hiring certainly can be volatile on a month-to-month basis, like we saw in April. So we're going to have to deal with the volatility around that, I think, continuing. But 3 out of the 4 are in green light, so that makes it in a pretty good position. So it's too early to say that we're back to normal. High levels of business and consumer confidence should continue to support additional spending on both the business front and the consumer front. But we've got to just keep watching these other indicators. So Brad and his team have left it for a yellow light. And I would just wanted to share that with our clients and kind of give you an update on where Commonwealth sees things. We'll have more in-depth discussion in our mid-year outlook and have a lot more of our opinions in there as well. But this is a good look at where we are today. So hope everyone is enjoying this end of spring and entrance into summer, and then getting out and doing some fun stuff, and hopefully having more fun in 2021. Thank you.